Hello, my name is Dan Beniak. I'm here with my colleague Sal Martone. We're both members of Treasury Partners Portfolio Management Team, and we're kicking off a new series to briefly recap the happenings in the economy and markets over the past month and looking ahead to the coming weeks and months. Sal, could you tell us what you've been seeing?
Yeah, sure. So markets have been weak and volatile recently. S&P's down 7% year to date. Corporate credit had been holding up. Now there's signs that that might be changing. Yesterday was April 2nd, so we got the Trump administration's latest tariff measures, which were more severe than the market anticipated, but they were consistent with Trump's past behavior. So we're monitoring several things. One of them certainly is how do other nations respond to the tariffs? How do they decide to adjust their own tariffs? Do they adjust them upward, or to decide to hopefully de-escalate the situation and lower their tariffs? Two, will Congress act with more urgency to extend the tax cuts and potentially even increase the size of the tax cuts? And then three, how does the Fed respond to higher inflation yet lower growth? Fixed income markets have also been volatile. The 10-year yield has declined 50 basis points year to date. But, Dan, what do you think? Now that we're past April 2nd, can markets settle down here?
That's the key question. It feels like the past weeks have really been leading up to April 2nd because of how momentous these tariffs could have been. And it does seem like the Trump administration delivered. Markets have been caught off guard. We're taping this on April 3rd, the day after so-called Liberation Day when the tariffs were announced. And risk assets broadly are selling off, meaning that equities are down across the board and bonds are actually higher in price because their yields are going down. As you mentioned, Sal, the 10-year Treasury yield is down significantly. We're getting close to breaching the 4% yield barrier on the 10-year, which is something we haven't seen in the past 6 months. Similarly, the short end of the yield curve is also going lower, reflecting additional market anticipation of Fed easing going forward in order to combat weakening economic conditions. But there's signs that other indicators are holding up. Corporate credit spreads, an indicator of market thoughts about how strong corporate fundamentals are doing, are holding up fairly well. So we're going to be in a wait and see pattern here going forward, and we'll be watching. Thank you very much for listening.
Thank you.